reacting into that bullish order block price. Secondly, we can see that there's quite an obvious capper in play here, isn't there? There's a capper in place at that point there. So we have that cap buyer coming in at that price. Now a seller comes in here and pushes the market down. Now obviously based on that structural break here, the high seller was that price there at that stage, wasn't it? Yes? So does everybody know where the measured move was? Does everybody know where the measured move was? It was at the bullish order block. Did everybody see that? Did everybody mark it? Did everybody go through the process of recognizing that the measured move of this structural break was the same area as the bullish order block at the bottom edge? I assume so. And I keep on making these assumptions because unless anybody pipes up and tells me, I'm just assuming you all had that measured move. I assume you all knew about the bullish order block. I assume you all knew about the very, very big buy side value. I assume you all know about the concept of the guaranteed premiums and discounts, yeah? We touched on the guaranteed premiums and discounts in an earlier conversation, and we made mention of it. What market was it in, guys? Can't remember. What market was it in? Any ideas? I can't remember. Anyway, it's not going to make much of a difference. But we talked about guaranteed discounts, we talked about guaranteed premiums, and we chatted through the idea that you must at least know and pay attention to these aspects. And the reason why you pay attention to these aspects is because of what reason? What reason did we give? What reason did we give? Price should not trade through a guaranteed discount. Price should not trade through a guaranteed premium. So when we know that that's the case, would you all agree that this is a guaranteed discount? Do you all agree that that's a guaranteed discount? What's a guaranteed discount? A guaranteed discount is when the value is not lower than the previous value, but the price has moved a measured move. That's called a guaranteed discount. In other words, you're guaranteed that the buyers will pour in at this price. That's the guarantee, right? You're guaranteed that the buyers will pour in at this price because there is no value on any world that you could actually agree with that any algorithm will sell at this price. And the vast majority of algorithms will look at this and say, nope, let's close. And they'll become buyers. So what happens at a guaranteed discount price? Well, what happens, of course, is we start looking for the green candle. We're looking for the green candle, right? That's called the systematic entry. It's called a structural entry. So at the guaranteed discount price area, and again, that's the important part because we don't want to look at it beforehand. Remember, the idea of a guaranteed discount is buyers going to be coming in. So if you don't see them, well, there isn't a trade yet. You've just miscalculated. There isn't any buyers coming in because they will show up, guys. They will show up. So when we use a structural entry, when we use this idea of systematic entry processes, and we simply buy when we get the first green candle at the guaranteed discount price, is it reasonable to now be long the market at that point? Is it reasonable to now assume that that is us ready to go and that we can now structure our trades around that bottom print? Is it reasonable to think that the first target price is this price here, which was obviously the guaranteed discount price break here, so we've got a capper in place here. So is it reasonable to think about that guy as a cap seller? Is it reasonable to think, therefore, that we should be able to make a measured move against that dude and try and take it up into this sell-side bearish order block? And therefore, that sell-side order block up there, that would be a reasonable price to go after for a possible target price. Now, if the value is improving when we hit that price, as it was, quite nicely improving, we would expect to then make another move. And the next move takes us up to this bearish order block, yeah? So what happens? What was our ultimate reward on that trade, guys? It was only 16.5 times our money, or 33% return on our account. 33% return on our account. How many bad trades are we now covered for? We're now covered for 16 bad trades in a row, and we're still going to break even on our account. Finding these trades is not by chance. It's just by design. It's by good engineering. The idea of finding guaranteed discounts, we've actually found quite a few today because we talked about it on gold. Guys were saying that it was gold that we talked about it earlier. When we've got a guaranteed price, and then we get the idea of that very, very nice entry point, we can understand that finding the sum of these narratives is just crazy. So when the value improved here, could you have taken an add-in 50-line trade? Yes or no? Could you have taken an add-in 50-line trade? Yes or no? Well, the answer to that question is 100%, right? Because when we get that cap seller's break, what do you replace it with? What do you replace the cap seller's break with, guys? We've done this in class plenty of times. Buyer's pending, right? We replace it with a buyer's pending line, yes? So when we've got the buyer's pending line, is this an area that we could expect to see a buy opportunity from? Yes. Is this an area that we could do a systematic entry process from? Yes. Have we got an automatic target price? Yes, it's the previous swing high, worst case scenario, so that we can start working into an idea that that's going to be at least where we want to be targeting in terms of a risk reward for a first exit, so that we're over better than a one-to-one reward. Do we all agree that the price that shows up as a systematic entry was this green candle here, following the touch that we got into that balance area? Do we all agree that from that buy trade, we've just exploded another massive winner onto the world stage? We've just exploded another massive winning trade onto those equity upsides. And obviously, we've just made a new break higher, which is what we expected to happen. We already told you we expected that to happen. And there you go, guys. This trade, 13.1 times our money, 26% return on our account. This trade, 18 times our money, 36% return on our account. So if that's 36% and 26%, even taking a little bit of slippage, you've probably done about 60% return on your account on those two trades. 60% return. 60% return on your trades, guys, during those processes. What do you think? What do you think, guys? It's pretty good, isn't it? Now, obviously, when we get this pullback, could you have done a systematic buy trade there, yes or no? Could you have done a systematic buy trade off of that rejection? Yeah, you could do a systematic buy trade anywhere, if it's got a reason to exist. If it's a level, if it's a wholesale price, if it's a cash market open, if it's a cash market close, if it's a day high, if it's a day low, if you've got value, you can do a systematic entry. So when I've got a level 2 liquidity and the value tells me that the price should be above the top edges of 37.95, and I'm looking at that 37.95 saying, you know what, give me a systematic entry and I'm in. And then you wait for that systematic entry so that if the price sells and it just keeps dropping, you're not in. So there's your systematic entry buy trade right there. These trades have now extended as we suggested they would. We told you not to take profits, didn't we? So we've now got a third trade on our books, haven't we? We've now got a third trade on our books, guys. There's the low price with a stop. And now we've got a third trade at the same time, which has done another 13%. 13% on the third trade, guys. Bearing in mind that our first trade is now sitting on 32%, our first trade is now sitting on the same as it was before. What happened there? 36%. That's not our first trade, guys. That's not our first trade. The whole thing's moved up. My mistake. How could it be the same? That's stupid, isn't it? So I just pulled the whole box up. I was wondering why it was the same. So there we go. It's now at 20.7 times, guys. 20.7 times. 41% return on our account. 41%, 32% make that 70%, and 13% make that 80% return on our account. 80%, we're nearly doubling our account size. In fact, if we go up to the next higher high here, and we go up to the next higher high here, and we go up to the next higher high here, we nearly get to double the account size, don't we? We nearly get to double the account size. 42, 43%, etc., etc. We're nearly at 90% return on our account. Nearly 90%, guys. Isn't that amazing? How it's possible to be so incredibly positive in this. If you think back to my comment at 3:30, my comment at 3:30 was that we had positive gamma as well. Testing the highs was not going to be unexpected. 3:30, right? The price wasn't at the highs at 3:30. So at 3:30, you'll see at 3:32, the price had actually dropped back off a little bit from the high prices. 3:32, we were still dropping away from the high price in that area. So you can see that when I sent out that message, we were expecting the price to test the highs. The price was trading 89s when I sent the message. From the point of 89s, it's now trading a high price of 11s. It's over $1,000 upside since I told you the S&P gamma was positive. Over $1,000 of upside. 3 likes for $1,000 bucks. My God.